Right, we're now going to be talking to Sanjay Mookim of JPMorgan. He's, of course, the head of equity research over there and the India Strategist. Thank you so much, Mr. Mookim, for joining us here live on the market. We're, of course, talking after the big Indian domestic event, which is Union Budget. The market's applauding that 35% hike in capital expenditure. We're all awaiting now for 9th of February and what RBI Governor Shaktikanta Das announces after the Monetary Policy Committee meeting. My first question to you is that given this higher outlay of capex, what's the best way to approach it from a stock market perspective? For example, you folks have been, betting so big on financials for over a year now, with a special focus on the private sector's banks.
Good morning. It's always great to be on. Look, let me step back and say that, the union budget this time around has had a very clear message, right? And you can imagine that the ministry and the government faces a lot of pressure every year from various constituents of the economy asking for relief in all kinds of measures. But at least the messaging from government has been exactly on point to say that we will use resources available to focus on capacity creation, long-term infrastructure build out in the country, and that we are still willing to print relatively high deficit numbers in order to facilitate that growth. That said, of course, there are some adjustments to the numbers that must be made. We've done our research on this and we've published notes to argue that the effective growth in capex is perhaps not as large as the 35% that was spoken of, but is probably a little bit more modest. But those are nuances. I think the message from the government has been relatively clear that the policy choice is on capacity creation, on infrastructure building. The second message, of course, in the budget is that the numbers are fairly conservative. So you're looking at government sort of trying to, under-promise and over-deliver, especially on the revenue front. The numbers are likely to be exceeded significantly for both FY22 and 23. So that kind of lays the backdrop where the government should be able to create some room, if the external environment remains stable, to actually spend a little bit more perhaps than they have promised. Now, what do you do from a market point of view, if that was your question? Yeah, I think there are two kind of conclusions there. One is that domestic consumption is a little bit weaker than people expected. This is no longer a forecast. This is now showing up in company numbers. It's showing up in company management. And there was hope, at least in some quarters of the market, that the budget will provide an immediate redemption through some sort of a handout scheme, through income transfers. And that hasn't happened. Which means that for consumption to recover, you will need a process of job creation, of income restoration, especially at the lower end of the economy, before demand numbers and volume numbers come back in. So we have been, cautious on the domestic consumer stocks for some time, and the budget, to my mind, only helps reinforce that view. And within that, we prefer the infrastructure, the lenders, over the consumer stocks in India.
Sure. Sanjay, hi, good to have you on the show, and after a long hiatus, I must say. So in the context of what you just said, Sanjay, just wanted to understand what happens to some of the spaces which have actually led the recent correction. For instance, the IT names. They've really sort of bore the brunt of, I don't know, whether falling under their own weight or aligning themselves with what's happening on some of the NASDAQ listed names, whatever you may want to call that. Are the good days for IT, the low-hanging fruit gains days of IT, clearly behind us? Or is there still scope for some selective re-rating from here onwards?
Good morning. I think on the IT, the initial comment I'd want to make is that this is not equivalent to the tech basket that we see in many other economies, right? And that tech, by definition, is assumed to be high growth and maybe hyper growth for a long period of time. So the duration of cash flows, and they're possibly negative cash flow companies as well, the duration of cash flow for tech elsewhere is very high. But the Indian IT companies are actually free cash flow positive. They pay dividends, they have buybacks, and that duration is not very high. So the rate sensitivity for Indian IT companies perhaps is not as high as the tech basket globally is generally believed to have. That said, of course, the IT companies in India had also seen a very significant re-rating over the last 1 year. Relative to the market, their multiples had become, 1, 2 standard deviation above average. So your comment on falling under their own weight probably applies a little bit better than, to my mind, equating them to a tech sort of sell-off. So I don't think that analogy is really valid for Indian IT companies. Business-wise, the momentum remains strong, and we've seen that in the numbers for the quarter. Top line has actually beaten even elevated expectations for many companies, and most have been able to manage margins despite whatever supply side pressures they're facing. So at least business-wise looks okay, but yes, the sector has been overowned. It's re-rated a lot, and may be consequently coming under pressure now.
Sure. Where do banks then lie in the entire piece of the pie, Sanjay? Because, while disruption is playing across categories because of ever-changing technology, it's more so within banks. And then there is that whole debate about how is it that one should be looking at PSBs versus private banks, and whether the private banks are richly valued right now, and whether within PSBs you find more of bottom-up stories, and is that really the way to play this entire banking catch-up that we are seeing?
Our fundamental thesis on banks is a disconnect that I think lies in macro assumptions in the country. While most, let's say, economists and forecasters assume that you're going to get 12, 13% nominal GDP growth in next year, people are still disbelieving of credit growth. Now, this is a gap. You're not going to get very high nominal GDP growth and get mid-single digit credit growth in the economy. These things need to move together. In fact, I would argue that if lending activity did not accelerate, then there's actually a risk to economic activity itself. So these two things need to move simultaneously. If you look at many of the financial companies in India, there is still a little bit of disbelief amongst investors that growth will come through. Okay. And which is the disconnect that we find attractive, to say that, look, if we are willing to assume that the cyclical recovery is happening in the country, then by default, implicitly, I am saying that this credit growth will also go up. In which case, some of the financial stocks, especially on valuations relative to market, start to look attractive. We are also reasonably confident that the lockdowns and the pandemic that has roiled us for the last 2 years will not lead to additional or any meaningful additions to asset quality, in which case we think that the earnings delivery of these banks will sustain the improvement they have already demonstrated. And therefore, on evaluations plus growth screens, the financials continue to look attractive. And like you said, we've been highlighting this for some time now. They continue to look attractive on a fundamental basis. On your question on PSUs, I'll just make the top comment here. If we believe the system credit growth is going to improve, then again, as a corollary, we'll have to assume that lending at PSBs will also have to improve, because they still are a very large part of the entire system.
Sanjay, hi there. Good morning. And now one cannot deny the rising inflation, which continues to hurt purchasing power. And while it's been a bit divided when it comes to earnings of a lot of consumption companies, HUL, Marico, for instance, have managed to see a margin expansion, or Dabur, for example. But some of the companies have been impacted, and they've acknowledged it. How are you looking at the overall earnings growth when it comes to the consumption space? And do you think that margin pressure will continue on the back of high raw material and input cost inflation?
Good morning. Let me start this answer with a very macro comment. The overall consumer environment, consumer confidence in India is still recovering from the shocks of the lockdowns and the pandemic. And I would suggest that the environment is not strong enough for companies to both increase prices and insulate margins and volumes. Right? So we are in a situation where I think many consumer companies now have this difficult choice to make. Do you protect volumes or do you protect margins? Right? And this we are seeing in the outcomes of many of these consumer companies, where different managements are making different choices. Some people are protecting their market share by not taking the price increases. Many are protecting margins by taking the price increases and consequently seeing lower volume growth. The problem, I think, is that this now contrasts with expectations in the market. And if you look at earnings forecasts for some of these consumer companies, analysts and investors are forecasting both volumes and margin expansion in the next year. And that is why I think that as a theme, many of these consumer companies will actually end up missing estimates on one of these metrics, either on volumes or on margins. And one of the quantitative reasons that we are actually underweight the space is because we think companies will disappoint these elevated expectations.
A pleasure as always, Sanjay, chatting with you. Thank you so much for running us through your macro insights as well as giving us a view as to how you're looking at the overall market and various sectors.
Thank you. Great to be on.